Now, I've been talking about trading in increments of 100,000 units of the base currency, and that's what we call a full lot. So a lot of a currency pair is 100,000 units of the base, whatever that happens to be, whether it's the euro or the yen or anything like that. And if the dollar is on the quote side, then we know that the pip value is going to be $10. So it's a really easy calculation to make. It doesn't require very much on our part to be able to do that. Now, that's a big position. So some traders is perfectly acceptable, but not all traders are that size, and they may wind up taking on too much risk if they're taking an interest in a currency pair that's worth 100,000 units of the base currency. So we can split this up. If we divide a full lot by 10, then we have a lot size that's worth 10,000 units of the base currency, and that's called a mini lot. And in fact, now we also have micro lots, which are, again, just a tenth of the size of a mini lot. So in those cases, a mini lot or a micro lot can be traded with a lot more precise control over the amount of risk that you're actually exposed to in the market. So you can really customize it to what you feel like is appropriate for your account balance and so forth. Whether that means you're trading in full lots, mini lots, or micro lots, or maybe a combination of all three, depending on the position. So let's go into this in a little bit more detail and take a look at an example of how this works out in a pretend trade. Now, we're purposefully staying really simple and basic just yet. We're not going to go into a lot of strategic details just now, but we will later. So to start with, let's use an example here of the dollar versus the euro. So we're trading the euro here. Let's pretend that an investor that they bought down here at this level. Now the exchange rate at the time was 1.19,520. Now let's assume that this investor, they were really good. They bought at the bottom and they wound up selling all the way up here towards the top. So we'll put in our sell price here of $1.25,020. Now we can do some quick math here and figure out, well, what's the difference there in pip value? And what we'd have to do is we'd figure out, well, what did they sell at versus what did they buy at? And if we do that, then we find that the difference in this case, and I'm going to write this down in pip terms. So how much did the exchange rate actually change in pip value? So if I do that, it works out that they had a change of 550 pips. Now we know that 550 pips, and we're going to assume a full lot being traded here, well, each of those is worth $10. So our hypothetical trader in this case, in a very short period of time and a very small percentage move in the Forex, might have been able to make, in notional terms here, $5,500 worth of value if their forecast, in fact, had been correct. Now we're going to go into that in a lot more detail as to what does that actually mean and what kind of risk did they take to, in fact, do that. But first, let's do a little bit more terminology. When are you long and when are you short? So these are terms you're going to get really familiar with in the Forex. Now what we just showed in the example on the euro was a long position. And what that means is that an investor who is long, they're buying and they hope to be able to get out of the trade at a later price that's higher than the one that they got in at. So they want to buy low and sell high. In the Forex, however, we're just as commonly going to be doing the other side of the trade. So in that case, we'd be shorting. And what that means is the investor is taking a position where they sell first. So hopefully they're going to sell high and then buy back low or close their trade low. Now, if you've never shorted stock or anything like that before, it can take a little bit of time to get used to what that actually means. But just take my word for it for now that when you are bullish on a currency pair or you think that the currency pair is going to rise in value, and we'll talk about what would cause that to happen throughout this course, then you're buying. And if you're bearish or you think that that currency pair's value is going to fall in value, then you're a shorter or you're a seller. So you're going to open your position by selling first. Let's do another example. So we just talked about this one where we opened a position at 19,520, so 1.19520 on the euro, and closed it at 1.2502. So this is pretty straightforward, 550 pips worth of value. But what if you had done this a little bit differently? So let's say, for example, here on the dollar versus the yen. So this is the dollar versus the yen, or we can summarize that just as the yen. So we're going to assume that an investor sold or shorted. So they shorted the yen up here in this range here. Let's say that they shorted it at exactly 114.100 at the top of the market. And later they wound up buying it back, let's say around 109.550. So they're going to buy it back. So buy to close their position. And they would have done that, let's say hypothetically, at 109.55. So we can do a little bit of subtraction here. We can figure out, well, what did they make? So if they sold high and then they closed it low, so they opened their negative position first and then they closed it out later by buying it back, well, what was the difference in pip terms? So then we can figure out, well, how much money did they actually make? So the change in this position in total pip terms would be 455 pips. Now we might have to do a little bit of a calculation to figure out what those pips are actually worth, which we've talked about, and we'll go into more detail on that later, especially when we have a currency pair that doesn't involve the dollar. But if we did that, we know that those pips are worth about $9.13 each. So $9.13 multiplied by 455 pips gives us a change in value for this trader of $4,154.15. So if we can keep straight what a pip value is and what it means to be long or to be short, then you're 2/3 of the way there to understanding what investors are actually doing when they're either buying or selling a particular currency pair. So let's review. If you're long, that means you're bullish. You think that that particular currency pair is going to rise in value. If you are short, that means that you're bearish. You think that that particular currency pair is going to fall in value. So if you are bullish, then you are buying to open and you are selling to close the trade. So you're buying first, selling later, pretty easy to understand. I think most investors are familiar with how that works. Shorting, however, it's a little bit different. Now here we're selling to open and we're going to be buying to close. So we're going to wash that trade out at the end by basically reversing the position. So we buy it back to close. So let's talk a little bit more detail here as to, well, how do we know which way we want to trade? How do I know whether I want to be bullish or bearish, depending on what I think about each of the currencies in a particular pair? So let's start with the euro. Now, the easiest way to think about this is if you think that the euro is going to rise in value relative to the dollar, then that means you're bullish on the euro, or you might just be bearish on the dollar. It might just be that you think that the euro is going to be stable, but for whatever reason, you think that the dollar may exhibit some weakness. Well, there are a couple of tricks to remember, well, depending on my forecast about these particular currencies, which direction is the chart going to actually trend? So here's what I would suggest. Imagine that you have a little seesaw underneath this particular currency pair. So we have the euro over here on the left, and we've got the dollar over here on the right. Now, we're just going to pretend that your forecast is that the dollar is going to gain in value relative to the euro. So in other words, it's going to gain some fundamental strength. Well, if it does that relative to the euro, which let's say it's either stable or it winds up weakening or maybe lightening up, it's going to shift that seesaw down and to the right. Well, what that means is that the chart will also be down and sloping to the right. So because the dollar is gaining in value relative to the euro. Now imagine that alternatively, the euro is gaining in value to the dollar, or maybe the dollar is weakening and the euro is just staying stable. So for whatever reason, the dollar is falling in value relative to the euro, and it's getting more fundamentally light, or the euro is getting more fundamentally heavy or strong. Well, that's going to slant our seesaw up and to the right. So we know that our chart will also be moving up and to the right. Now let's look at this in a couple of examples that we did previously. So here I have the euro to the dollar. It is sloping up and to the right. So if we draw in our little seesaw here, euro on one side and the dollar on the other, and what does that tell us about the fundamental value? Well, it would be in favor of the euro relative to the dollar. It doesn't even mean that the euro is doing really great. It could mean that the dollar is just doing poorly at the time. So that is slanting that seesaw. Now let's go a little bit further. Let's say in this case, we've got the dollar versus the yen. So let's draw our little seesaw here. And we have the dollar on one side. This way we don't even have to worry about whether the dollar is being quoted like it is on the euro or not. Because what this is telling us is that during this period of time, the yen was gaining in value relative to the euro. That's why it was sloping down and to the right.